Picture the final minutes of a football game. The score is tight, the crowd is loud, everything feels tense, and suddenly the defense sends a blitz from every direction. That's what geopolitical shocks feel like in the financial world. One moment markets are moving normally. The next moment, headlines hit, oil prices spike, and investors scramble to figure out what just happened. Right now, tensions involving Iran have created exactly that kind of moment. Oil markets reacted quickly, stock markets turned volatile, and global investors started asking the same question: what happens next? Today we're breaking it down football style, looking at the kickoff, the first hit to markets, the sectors making big plays, and what smart investors are watching as the economic game unfolds. Because when the blitz comes, preparation matters more than panic. Why the Strait of Hormuz matters. Every football game starts with a kickoff. That opening play often sets the tone for everything that follows. In global markets, the kickoff of this crisis happened in one critical location: the Strait of Hormuz. This narrow waterway sits between the Persian Gulf and the Gulf of Oman, and it handles roughly 1/5 of the world's oil supply. Every day, massive oil tankers move through this corridor, delivering energy to global markets. Because of that, the Strait of Hormuz is one of the most important economic choke points on the planet. When tensions rise in this region, markets react almost instantly. If shipping slows or stops, global oil supply tightens. Traders begin pricing in the possibility of shortages, and when supply concerns rise, oil prices move fast. This is why geopolitical tensions in this region always grab the attention of investors. Energy is the lifeblood of the global economy. When it gets disrupted, everything else feels the shock. The first hit, oil prices surge. The first real market impact of the conflict came through oil. As tensions escalated, crude oil prices began rising rapidly. Traders started factoring in the risk that supply could be disrupted if the conflict expanded, or if shipping routes became unsafe. Some analysts even warned that oil prices could push toward $120 per barrel if disruptions became severe. Think of oil like the offensive line of the global economy. When it's stable, businesses run smoothly. Transportation works efficiently. Companies can plan their costs. But when oil prices surge, the impact spreads everywhere. Airlines spend more on fuel. Shipping costs increase. Manufacturing becomes more expensive. Even grocery stores feel the pressure through higher transportation costs. And when businesses face rising costs, those increases often get passed to consumers. That's when inflation starts creeping higher. And financial markets pay very close attention to inflation. After the news broke, stock markets reacted quickly. Major indexes like the Dow Jones Industrial Average dropped as investors rushed to reduce risk. When geopolitical uncertainty rises, many traders temporarily move money into safer assets while they evaluate the situation. At the same time, the SIBO Volatility Index jumped higher. This index is often called Wall Street's fear gauge, because it measures how much volatility investors expect in the near future. When the VIX rises, it usually means traders are bracing for bigger price swings ahead. In football terms, it's like a team taking a sack on third down. The offense pauses. Coaches reassess the situation. Everyone adjusts before the next play. Markets behave the same way during geopolitical shocks. Investors pause. They reduce risk. And they wait for more information. Which sectors benefit and which struggle? Here's something interesting about market shocks. Not every sector reacts the same way. Just like in football, some players benefit from certain plays while others get caught off guard. When oil prices rise sharply, energy companies often benefit. For example, companies like ExxonMobil and Chevron typically see their stock prices move higher when crude prices surge. Higher oil prices can increase their potential revenue and profit margins. That's why energy stocks sometimes move up even when the overall market is falling. But other industries experience the opposite effect. Airlines, cruise companies, and travel-related businesses often struggle when oil rises because fuel is one of their largest expenses. If fuel costs climb too high, their profit margins shrink quickly. It's like a defensive blitz in football. Some players get burned by it, others break through and make a big play. The same event can hurt one part of the market while helping another. The inflation chain reaction. Now, the story gets more complicated. When oil prices rise, the impact doesn't stop at the energy sector. Consumers feel it at the gas pump first. Gasoline prices often climb when crude oil rises, and households notice that immediately. Higher fuel prices mean transportation becomes more expensive. That increases the cost of moving goods across the country. Eventually, those higher costs can show up in everyday items, groceries, deliveries, and services. That's where inflation becomes a bigger concern. And inflation creates pressure on central banks like the Federal Reserve. If inflation rises too quickly, central banks may keep interest rates higher for longer to slow the economy. Higher interest rates make borrowing more expensive for businesses and consumers. That can slow economic growth. So what started as a geopolitical conflict can ripple outward into energy markets, inflation, interest rates, and economic growth. It's a chain reaction. One event leads to another. What smart investors are watching right now? Experienced investors don't panic during geopolitical shocks. They watch the field carefully. Right now, there are 3 key signals many investors are tracking. The first is oil prices. If crude oil remains above $100 per barrel for a long period, inflation pressure could increase significantly. The second is shipping activity in the Strait of Hormuz. If tanker traffic slows or insurance costs spike, global supply chains could tighten further. The third is market volatility. Sharp spikes in volatility often create opportunities for long-term investors because prices can swing more than fundamentals justify. In football terms, volatility is like a turnover. For one team, it's chaos. For the other, it's an opportunity to score. The same applies to markets. Short-term panic can create long-term entry points for disciplined investors. Here's the most important perspective. Geopolitical crises have shaken markets many times in the past. Wars, regional conflicts, and global tensions often create short-term market drops because uncertainty rises quickly. But historically, markets have recovered over time. The S&P 500 has experienced wars, financial crises, and global disruptions over decades. And yet the long-term trend has remained upward. That doesn't mean volatility won't hurt in the short term. It can. But experienced investors understand something important. Headlines change quickly, market cycles continue, and portfolios built with diversification and patience tend to survive these shocks. How investors historically handle geopolitical shocks. There's another pattern worth remembering when global tensions rise. Markets often react immediately to geopolitical news, but the long-term impact depends on whether the conflict disrupts economic fundamentals. For example, during several past Middle East tensions, the initial reaction in the S&P 500 was a sharp drop, followed by a gradual recovery once investors understood the real economic impact. In other words, the first reaction is usually emotional. Investors rush to reduce risk. Headlines amplify uncertainty. Volatility spikes. But as more information becomes available, markets begin adjusting to the new reality. That's why experienced investors focus on fundamentals rather than reacting to every headline. They ask questions like, will energy supply actually shrink? Will global trade routes remain open? Will central banks change policy because of inflation? These factors determine whether a geopolitical shock becomes a short-term scare or something that reshapes the economic game plan. Right now, the global economy is facing a high-pressure moment. The conflict involving Iran has created uncertainty in energy markets, rising volatility in stocks, and concerns about inflation. It feels intense, like a fourth-quarter drive with the defense blitzing from every direction. But markets, like football games, are long contests. Short-term plays can change momentum, but they rarely decide the entire season. The investors who succeed over time are the ones who stay calm, watch the field carefully, and adjust their strategy without panicking. Because when chaos hits the market, patience often becomes the winning play.